I wanted to do a quick primer on options, sort of a options 101. If you're new to options trading, and this is a little bit daunting at first when you look at new verbiage, new terms, new definitions, and so let's break it down to a simplistic approach here. One of course, the first questions that I always get asked when we look to trade options is, are options safe? And the answer that I always give is the same. Options are neither safe nor risky. They just simply are. They're an inert commodity, and it is really you and I, as human beings, how we choose to approach it that determines its risk. Same thing with the stock market. I would not say that the stock market is safe. I would not say that the stock market is risky. It just simply is. It's how you and I choose to approach it that determine those levels of safety or those levels of risk. The one thing that is a little different with options versus stock is that options expire. They go away. They are what are referred to sometimes as wasting assets. Could you buy a stock at 10, watch it drop to 5, and then sit on it for the next 10 years hoping for it to come back in price? Well, you could. I don't know that I would recommend it, but you certainly could. You can't do that with options. They go away, they expire, they mature. So that's one key difference with options. The easiest way that I know of to explain how options work is through the use of a real estate example. I don't know why it is. Maybe real estate is just more tangible than the stock market, but I think when we use real estate, it clarifies it a little bit. It's the same for the stock market. Let's say that you have a home for sale for $100,000. Now that would be a nice price for that home right there, but let's just say for simple round numbers that you have a home for sale for $100,000. I'm a real estate investor. I'm out looking at deals. I see your deal, and I feel like your home is underpriced. I feel like it's maybe worth more like maybe $150,000, maybe even $200,000 in value. And so as a real estate investor, that excites me, that entices me, and I would love to be able to make some money from your home. Now, there's a lot of ways that I could do that. One way would simply be to come up to you with $100,000, purchase your home, and then turn around and hope that I could flip it to someone else for 150 or maybe even 200,000. But I don't really want to do that because, number one, even if I have $100,000, I don't know that I want to tie it all up in one single transaction with you. And so there might be an easier way to go about this, and that is using a option. Now in real estate we call it a lease option or a purchase option, but it's the same principle in the stock market. I could come to you and say, look, Mr. and Mrs. Homeowner, I understand you have your home here for sale for $100,000. I want to buy it. But here's how I want to structure that deal. I would like to give you a non-refundable $3,000 premium or a $3,000 payment. And for that $3,000, I'm going to get the exclusive right to buy your house from you for your asking price of $100,000 over the next 3 months. So you as a seller say, okay, wait a minute, let me just understand this. You want to give me $3,000, and for that $3,000, you're going to get the exclusive right to buy my house from me over the next 3 months. And it's going to be done, the contract price will be done at my asking price of $100,000. And I say, yep, that is exactly correct. And so you say, you know what? Sounds great. Give me the $3,000. So at this point now, I've given you the $3,000, and maybe a day or two goes by and we get a news flash. Gold was found in your backyard. Now, obviously, this is pretty exciting for me. It's not too exciting for you. But then maybe a little bit more time goes by and we get another news flash, and it turns out that it was not only fool's gold, but your house was full of termites. You just hadn't done a good job keeping up with your house, right? And now, of course, I'm the one that is depressed in this process. But that's a little bit the nature of options. They give you a massive amount of upside with very limited downside. Let's say that gold was found in your backyard and your home is now worth, say, $1 million. Well, that's tremendous leverage for me. I tied up your entire home for $3,000 and was able to make $1 million profit off of that. Massive, massive leverage. That's one of the reasons that people like options, is because of the leverage that they can bring to the table. But if we're wrong and the newsflash was bad, or in the stock market's case, we were wrong in our decision making and the trade went against us, we're not risking $100,000. We're only risking $3,000. So options really can give us the best of both worlds. They give us more upside, and they also give us the ability to control our downside. So in the options world, there's two types of options. There's calls and puts. And here's the definitions of each one of these. Let's go through them quickly and then we'll talk about them. Buying a call option gives you the right but not the obligation to buy a stock at a set price on or before the set date. That's a call option. So calls and puts, they do exactly the opposite of each other. So it makes sense that buying a put gives you the right but not the obligation to sell a stock at a set price on or before the set date. So let's look at that. Let's talk through this. Call options give us the right but not the obligation. So when I purchased that call option on your house, I had the right to buy your home, but I wasn't obligated. I could walk away from that deal at any time. Of course, I'm just foregoing the $3,000 that I gave you. So purchases of options gives you the right but not the obligation to buy a stock at a set price. Now, in the stock market, the set price is called the strike price. So you need to remember that term as we go forward here. The set price in the stock market is called the strike price. Strike price, okay? And on or before the set date. And I think in our example, the set date that we used was 3 months. So if I come to you 3 months and 1 day from today and say, listen, I want to exercise this call option, which gives me the right to buy your house at the set price or the strike price of $100,000, you would just say simply, well, your option has expired. That $3,000 that you gave me, I'm going to keep it. It's all mine, okay? So that's buying a call. Buying a call gives you the right, but not the obligation to buy a stock. Buying a put gives you the right, but not the obligation to sell a stock. And again, it's at a specific set price. The set price in the marketplace is what we call a strike price. This is market terminology, a strike price. And then a set date. Every option that we trade has a maturity date. A date that it is going to expire on, okay? So calls and puts. Now, a couple of little things to just kind of keep in mind as we're looking at options versus the stock market. Stocks trading shares, options trading contracts. But one option contract, controls 100 shares of stock. So if I wanted to be in a position to control or own 400 shares of Coca-Cola Corporation, for example, I would need 4 option contracts. One contract equals 100 shares of stock. So keep that in mind as we are looking at option trading. Now, we said that options expire, that they are what we refer to as a wasting asset. Well, the set date is the expiration date. So when we talk about the set date, that is the expiration date. See, almost always happens on Fridays. There's a couple of times each year. Good Friday is one of them, where we have a holiday on a Friday. The market's closed. This year, the 2020, we had Christmas was on a Friday, and so we had the expiration on a Thursday. But almost always going to happen on a Friday. Now, there's different option cycles. It could be weekly, it could be monthly, it could be quarterly, it could be daily. It could be what we call a 0 day to expiration, okay? But they always expire on Fridays. So expiration dates, that's critical as we look to trade these. Remember, it's pretty easy to remember how these work. Call options, we use those to make money when stocks go up. Put options, we use those to make money when stocks go down. The easiest way to remember this, folks, if you think about the old-time telephone, I don't know if any of you have one of these at home still or not, but if you remember how telephones used to work back in the day, when an incoming call would come in, you would pick up the receiver or call up. When you're done with the phone call, you would put the receiver down, put down. So call up, put down. Calls make money, or increase in value, I should say, when stocks go up. Puts increase in value. Puts make money when stocks go down. Okay? So, premium. This is an interesting phrase. The money or the credit or the income that we receive from options. When we sell an option, it's called premium. So if we sell an option for $100, that money, that $100, is referred to as premium. It's the money that we either receive when we sell an option or the money that we pay when we buy an option. Well, where does that number come from? Let's say that the premium was 103. Remember that that is a per share number, okay? Because one contract represents 100 shares of stock. So $1.03 would actually equal $103 of actual money. Where does that premium number come from? Well, it comes from two different sources. Intrinsic value, or IV, and time value, or TV. Okay? So let's just talk about these a little bit. Intrinsic value and time value. Time value is pretty straightforward. Obviously, you understand this concept that time is money. Well, that's very apparent in the options market. What if I came to you on the example that we were doing before on your house, and I said, listen, I'm going to offer you $3,000 for the exclusive right to purchase your house from you at your asking price of $100,000. I want to do that for 3 months. And you say, yes, that sounds fine. And then as soon as we go to shake hands, I say, you know what, I want to make one slight alteration to that deal. You know, we talked about doing this for 3 months. I want to change that period of time to 3 years. Well, you may very well say, you know what, that's fine. You can time my home up for 3 years, but it's I'm going to have to charge you a lot more than $3,000, right? Time has a value associated with it, but so does intrinsic value. And so let's talk about the difference here between intrinsic and extrinsic value. Let's say that we have a stock that is a $35 a share stock, and we're looking at trading some options on it. Now, there are all kinds of different strike prices that we could go out and trade on this particular stock. But the one that is at $35 a share, that's considered at the money. That's at the money because the strike price is the same as the stock price. Everything above that number is out of the money or extrinsic. This would be extrinsic value. Anything inside of this area right in here is called in the money or intrinsic. Okay, intrinsic value. So the strike prices, again, remember, these are the prices that we have the right to buy that particular stock at. So anything below this line would be intrinsic value. Anything above would be extrinsic value. Now, this is why we want to be able to understand this. Intrinsic value, guys, it's just simply the in the money portion of an options price. In other words, it's the difference between the strike price and the current market price of our underlying asset. So for example, again, let's say that we have a stock and that stock is at $35 a share, and we just purchased a call option at a strike price of 25. Well, we have the right to buy this stock at 25. The stock's at 35. The difference between those two is 10. That's your intrinsic value. Okay? So intrinsic value, it's just simply the in the money portion of our options price. Now, let's talk a little bit about why options are so preferable in so many situations. Let's take a look at a stock that, let's say, is a $30 a share stock. If we wanted to buy 1,000 shares of that, that's going to be $30,000. That's a lot of capital. Now, we could use margin. Margin, of course, is where our broker will lend us half of the money to trade with, but nevertheless, we're still on the hook for $30,000 regardless of where it comes from. And that can be a lot of capital. A lot of people say, listen, if you're going to trade individual stocks, you should have at least a dozen different stocks. You should be diversified over a dozen different positions. Well, obviously, if that's the case, it's going to require a lot of capital. And that's true. Stock trading, as wonderful as it is very, very capital intensive. Not so with options, okay? So instead of investing $30,000 in this trade to go out and purchase the stock directly, how about we use a at the money call? We buy a 30 strike price call option. Now, because it's at the money, it has no intrinsic value, correct? The whole value of this option, the whole $1 value, is time value, okay? So it's a $1 option, 10 contracts. Why do we want 10 contracts? Well, remember, one contract controls 100 shares of stock. We want to control 1,000, so we need 10 contracts. 10 contracts at $1 per share. Well, that's a $1,000 investment. Now, I didn't go to math college, but it's even plain to me, it's apparent to me that it's going to be a lot easier to get up and running as a trader. It's going to be a lot easier to make mistakes. It's going to be a lot easier to scale your trading if you only need to come up with $1,000 versus $30,000, okay? And again, you're controlling the same investment. This $1,000 investment is controlling 1,000 shares of that stock. So one of the things that we talk a lot about in our system here is that we buy options to sell them. We do not buy options to exercise them. See, I don't really want to own your home, right? What I want to do is find someone else that wants to buy your home, and I want to flip that option to them. So we're not really looking to exercise options. We're just looking to use them for profit directives. Now, this very convoluted screen here is what's referred to as an options chain, and every brokerage account has these. The way that the mechanics behind it, the way that they structure it, is a little different from broker to broker, but this does give you a fairly good idea of what we're looking at when we look at an options chain. Number one, you can see on the left-hand side are call options, on the right-hand side are put options. Right down the very center of this is a couple of important pieces of detail. Number one, expiration date. When are these options expiring? And then number two, you can see all the different strike prices. Now, this particular underline that we are trading here is XLF, and you can see at the moment here when this screenshot was taken, it was priced at about $17 a share. There's options from $7 all the way up to $22, okay? So there's all kinds of different strike prices that we could pick to go trade this option. Of course, the $17 strike price would be the at the money choice, okay? Over here is our prices. This is our bid-ask spread. Remember, with options, they are the same as stocks. If we take a look at a bid-ask spread, let's look at this one right here, okay? Everything that we trade in the stock market has a bid price and a ask price. We buy at the ask, we sell at the bid. You can kind of think of this as retail and wholesale, okay? We buy, in this case, at 51 cents or $51, and you could sell at 47. The difference between those two, that's what we call the spread. And the spread goes into the market maker's pocketbook. That's how they get compensated for providing liquidity in the marketplace. So one of the things that's difficult in understanding options trading is all of these things right in here. This thing, the delta, the gamma, the theta, the vega. What are all of those? weird statistical numbers running down these columns? Well, they're called the option Greeks. And for a lot of people, they are Greek, but they don't need to be. Okay, they're referred to as the option Greeks because they're named after Greek letters of the alphabet. There's the delta, the theta, the vega, the gamma, and the rho. Now, this is a concise, technically correct definition of what the option Greeks are. Let's go through it and then we'll talk about it. They are a group of statistical references that identify and quantify an option's sensitivity to different stimuli, such as movement in the stock price, movement in implied volatility, and finally, the passage of time. So, in plain English, what that's simply saying is that the option Greeks tell us when an underlying asset, when a stock goes here, there, or nowhere, this is how the corresponding option on that stock will react. Okay? Wouldn't it be nice to know, hey, if my stock that I'm looking at trading here, that I have an option on, if it goes up $1.25, I know exactly what that's going to mean in terms of a profit or loss on my options position. Okay? So that's the option Greeks. Now the first one is the delta. Delta does a couple of big things for us. Number one, it tells us the amount an option will move based on a dollar change in the underlying stock. Deltas are rarely 1-to-1. So if we have a delta of 0.6 on our option position, all that's simply telling us, folks, is that for every dollar that our stock goes up in price, our corresponding option is only going to go up 60 cents. Okay? So that's one thing that the delta does. But one of the things that it also does that's very important, it's also part of the calculation that gives us probabilities of a stock moving a certain percentage in a specific time frame. What's interesting and what I love about options trading is we can build an options trade and we can say this specific trade over a specific time has a 82% POP. POP stands for probability of profit, or 73%, or 91%. But we know that number right up front. We can tell you right up front what the probabilities of a certain options trade making money are. And part of that really, really complicated mathematical formula through looking at standard deviations in historical versus current implied volatilities, that is the delta. The delta is so important in that calculation. Theta. We talked about how options have expiration dates. The very second that you buy an option, the clock starts ticking. It starts eroding the value of that option. Wouldn't it be nice if you spent $1,000 on an option to know how the passage of time was going to affect that? Well, theta. Theta is the options Greek that will track that for you, and you can use that to monitor that. Vega. Vega measures changes in volatility. The more volatility in the marketplace, generally the more expensive options are. And so we need to know how Vega coming in and out of the marketplace is going to affect our positions. Gamma just measures the rate of change in the delta. The closer you get to expiration of an option, the bigger the gamma. The little teeny tiny movements in delta when you have a month left to expiration cannot even budge the price of your option. But if you are 15 minutes away from expiration, it will move that position. So gamma measures the rate of change in the delta. If you think about the delta as the gas pedal in a car, and gamma is how much you push on the gas pedal. Okay, rho is a option Greek that is not used very often anymore because it measures how an option's value would change relative to a change in interest rates. Interest rates are basically zero right now. So at some point, rho will become important, but it isn't right now. One of the things that we talk a lot about with options is that we tend to focus on being option sellers rather than option buyers. We would rather be net sellers of options rather than net buyers. The reason for that, there's a multitude of reasons, but this is from the OCC, the Options Clearing Corporation. They are the entity that is in charge of matching up all of the buy and sell orders in the options marketplace. One of the things they've found over time is that about 35% of all options expire worthless. About half of them are bought or sold or closed out prior to expiration, on only 17% ever get exercised. And so, guys, again, if we understand that 17% of these are going to get exercised, that means these are profitable. We don't really know what that means with these, but it does mean that 83% of these do not get exercised. It implies that they are not profitable. And so if you know right up front that any given strategy, when you buy an option, is going to put the odds against you in terms of your ability to come out ahead, in other words, we know we got an 83% chance of losing money on that trade. Well, rather than buying options, why don't we sell them? Why don't we be the individuals that sell the options to these people and to these people and to these people? And now we have an 83% chance of winning. Okay? Doesn't guarantee us a profit, but boy, sure puts the odds in our favor, right? So that's a little overview, folks, of how options work, why we use them in our trading system. If you have any questions, you can always feel free to reach out to me on Twitter. My Twitter handle is @ThetaSeller. I am always available 24 hours a day, it seems like, to interact with you guys. And also make sure you subscribe to my YouTube channel. It's youtube.com/sleep/Scott Stewart Theta Seller. I'm always trying to put up new content for you guys on a weekly basis. Talk to you soon.